Welcome back, guys. For those who are completely new here, consider subscribing to my channel and also watching this video till the end and also liking this video. Click the bell icon so that you are notified whenever I post new content up for you on here. So thank you, guys. Let's jump right into it. Today we have a new strategy that I'm going to be sharing here on the screen. So I want us to watch this video till the end and consider paying attention to everything that I illustrate on here. Okay, so this is a strategy that I've called the reversal strategy based on ICT concepts. All right, it's a reversal strategy based on ICT concepts, as I'm going to be sharing with you. So consider watching till the end and pay attention. Okay, so this is very important. The first thing and in this strategy we are going to be looking at is market structure. So market structure, pretty basic, right? Market structure, support and resistance, order blocks. We are going to be looking at fair value gaps and imbalance in the market. We are going to be looking at change of character. We are going to be looking at liquidity grab or liquidity sweep, like some people like to call it. And we are going to be looking at how to enter this market and when to exit. All right, so using this strategy, it's a very effective strategy that is winning most of the time. It has a very high win rate. I've applied it to my trading myself, okay, and I've seen significant increase in my win rate. So pay attention to this. So market structure, first of all, is basically the direction which the market is taking. Okay, depending on your time frame, it doesn't matter if you are trading in a 5 minutes or 10 minutes or 1 hour, 1 day, 1 month, weekly time frame. It doesn't matter. This strategy applies in all time frames. So if your market structure is telling you it's a bullish, it's a bearish trend or bearish market, or it's a downtrend, it's a downtrend means it's forming lower lows and lower highs. If your market structure is forming lower lows and lower highs, it means that's a downtrend. It's a bearish market structure. Until it gets to, that means it's forming break of structure. Okay, it's forming break of structure. For example, this is a break of structure here. Okay, break of structure, break of structure, break of structure. It's forming lower lows. This is a lower low, this is a lower low, this is a lower low, and it's forming a lower highs, like here. This is a lower high. Okay, this is another lower high, this is another lower high. Okay, this is the most recent lower high here, and it's our point of interest also. I'll just type it out. This is our lower high here, lower high. Okay, that's the most recent lower high. I'll just change that to red. It's our most recent lower high up here. Okay, so we're just going to leave it there. So the next thing after we have determined the market structure is bearish. That means going down. We're looking for our reversal area. We're looking for our reversal area to go bullish. We're looking to buy in this downtrend. Okay, we're looking to buy, but we buy at support. As you know, you buy at support and sell at resistance. So in this downtrend, when it hits our support area, okay, let's assume this is our support area. We draw our support area. Okay, this you draw it considering the past where the price has failed to break below. Okay, support is where the price has tried several times and it has failed to break below. Okay, it has tried several times and failed to break below. Okay, so that becomes our support area. The price has failed to break below that area. So when you draw your support, make sure that it has been tested at least two times. This is support. Okay, this is our support area. Change that to blue. Okay, so this is our support area. When we get to our strong support area, when the price gets there, there's an impulse move. In this strategy, you will see an impulse move to the upside, breaking above the most recent lower high, which is this one. It breaks above and forms a new high price. All right, so we are looking at that bullish impulsive move to the upside, this one here. all right, which causes a change of character. This would be a change of character right here. I'll just type it out. This is a change of character, change of character. That would be a change of character, all right? That would be a change of character right there. Okay, here, that's a change of character. It means there is a new price which has been formed up here. This is the new price up here. This is the new price which has been formed up here. That would be the new price. Okay, that's the new price. So this price, hold on, I'll just make that new price blue. When the new price forms, which is higher than the lower high here, then that confirms that there is our order block is down here. Usually the order block is just a candle, guys. It's a candle. The order block is bearish. Looks something like this. Okay, your order block may look something like that. I'll just turn it to red. Okay, I'll just turn that to red. So that would be our order block. When you see this change of character and the price has broken above the lower high, the order block has to be formed below here, down here at the support area. It's usually the last red candle in the bearish market. So usually the last candle before the aggressive bullish move. It's usually something like that. So the next candle here would be bullish. All right, I'll change that to blue. The next candle also would continue upwards aggressively. It is an aggressive move that changes character, that causes a change of character to the upside, something like that. So this last red candle is what we call our order block. We draw our horizontal line at the highest price of that red candle and at the lowest price of that red candle. Okay, something like that. You can draw lines or you can draw a rectangle. In between those high and low prices, okay, is the order block area. It becomes the order block. I'll just type it out there. This is the order. This is our order block. Okay, it is a zone. So you are looking at our order block right there. This would be our order block between the high and the low price of this last red candle before the impulsive move. It's before this impulsive move, guys. All right. So remember that it's before this impulsive move to the upside that causes change of character. So that last red candle is our order block. So when this happens, okay, so we have confirmed the market structure is bearish. At our support, we have seen this kind of formation, okay, an impulsive move that changes character, and as the new price has been formed, okay, and in between here, after the change of character and this impulsive move, in between here, there is a fair value gap or imbalance in the market. Usually a gap that is formed like that. Sometimes more than one gap, there could be two or three. Okay, so you have a gap that is formed like this one. So this would be our fair value gap. Okay, this would be our FVG. So that's our fair value gap right there. It's usually formed because there is an aggressive move to the upside. Buyers are more in control than sellers. There is little or no selling pressure at all here. So you have only buyers in control very aggressively. So it leaves gaps in the market, an imbalance. You know, market has to be both selling pressure and buying pressure. But if there is little or no selling pressure at all, it creates such imbalance in the market as the market goes bullish. Okay, it creates such, and the reverse is true. All right, so when such gaps are formed, usually what the price does is that it returns to close off the fair value gaps before it goes to the upside. So usually there is one or two or three fair value gaps even in this impulsive move. But for our illustration here, we just will show only one. So there is a fair value gap, okay? But in our strategy, we are looking at buying at the order block because there is a liquidity that is gathered below the support. As you know, some buyers, I will show you something. Some buyers had placed their orders here, all right? Previously placed their orders here, all right? Like this, all right? And so there's so many orders, buy orders here. There are so many buy orders at the support. So many traders have placed their stop losses just below here, something like that. So they have placed their stop losses here, below here, okay? So because they have placed their stop losses below here, okay, there's going to be a liquidity sweep, okay, down below before the price rallies all the way back upside. So we are anticipating the price to return close of fair value gaps, go to the order block, and even sweep the liquidity down here before we can see a formation like a bullish engulfing candle or three white soldiers or double bottom at the order block area or at the support, okay, at the order block area, indicating an upward movement. So we'll place our buys after that confirmation of a bullish engulfing candle going back to the upside, or three white soldiers or double bottom, whatever candlestick pattern you want to use for your entry, okay, to the upside, and target your new high up here. There would be your target, okay? That would be your target over there, all right? That would be your target. So this down here would be a liquidity sweep down here. This would be our liquidity sweep, all right? This would be our liquidity sweep here. That would be a liquidity sweep, okay? That would be our liquidity sweep here. Normally there is a spike, okay, that takes out stop losses. There's a spike that takes out stop losses here, okay, before, like a week, a long week that takes out stop losses here before we can see that the reversal all the way. That's why this is called a reversal strategy, okay? The price returns all the way from the new high, closes fair value gaps, returns to the order block, sweeps liquidity below the support before rallying back to the upside. So our target would be here. This is our target at the new high. Target the new high. Target new high. Okay, new high. That would be our take profit. Okay, that would be our take profit. All right, that would be our take profit area. Our stop loss just below the spike. Okay, I'll just indicate here our stop loss just below. Our stop loss would be right there, okay? Our stop loss would be here after the sweep. Remember that after the sweep, after a long week, so below that week or below the fake out usually is where you place your stop loss after you have confirmed a bullish engulfing here, up here within the order block and supply zone. You place your trade after you have confirmed an upward movement is coming, like with the order, a bullish engulfing candle stick pattern or three white soldiers or double bottom at this area. So your entry would be here. Your entry would be here after a confirmation of a bullish engulfing candle stick pattern here. Okay, your entry would be there. Okay, that would be your entry where you have something like a bullish engulfing candle here. Okay, if you have a formation like this, then you enter the market, okay, and target the new high. So if you have, this would be your entry here with the bullish engulfing candle. All right, your entry would be there. All right, so watch this and see how this moves. Okay, this is how this strategy works. First, you determine the bearish. Okay, the market structure is bearish in this scenario. At support, make sure it's a strong support. At support, you determine the order block, you identify the order block, okay? And then you mark out the high and the low of that order block, all right? Mark it clearly. And also watch the impulsive move, which creates a change of character, creates a new price, a new high above the previous lower high. When it creates that new high, then you wait for the return to close the fair value gaps, and within the order block, after the liquidity sweep, you can take your trade, your buy trade after confirmation on lower time frames of your bullish engulfing candlestick pattern, or a double bottom, or three white soldiers, whatever candlestick pattern you're using, to the upside. And then you place your buy order right there, okay? And target, put your stop loss just below the sweep, okay? Liquidity sweep, and target the new high up here. Target the new high up here, okay? Let's just remove this to avoid a confusion. We target the new high up here, okay? We'll target a 1:2 ratio. Put your stop loss just here and target a 1:2. This would be your target right here. So your stop loss, your take profit would be right there, okay? Your take profit would be right there, okay? So that is how you would trade this, all right? Take note of that. This is very important, okay? Remember this, all right? So this is how it would look like in a bearish market. On a bullish market, it's just the reverse. It's just the reverse. In the bullish market, it would be something like this. Let's assume this is our bullish, okay? This is our bullish structure. The market is very much bullish. And then we see a reversal like this one, which causes a change of character here. There's a change of character right here. Okay, there's a change of character right there. Okay, that's a change of character. So this is our resistance up here. This is our resistance area. Okay, I'll change that to orange. Okay, that would be our resistance area. So this is our resistance. This is our resistance area. Change that to red. Okay, so this is resistance area. Resistance is the area where price has failed to break above previously. Price tried here, it failed to break. Okay, failed to break above. Okay, failed to break above, and then tried again. Okay, failed to break above, and tried again at least 2 or 3 times. Tried but could not break above. All right, so that becomes a support, as a resistance. Okay, so if there is such resistance, the price is expected to drop from this resistance area, because there is a strong resistance here resisting a break above, the formation of higher prices. Okay, so it means there is much selling pressure at resistance. You know, when you buy at resistance, it's a supply area. So most people will be selling at this area. That's what is preventing the price to go higher. There is higher selling pressure around here. So you have this, if you have this kind of impulsive drop to the downside, okay, forming a new low. This is a new low. Okay, this would be a new low here. A new low. That would be a new low price, okay, forming here. Okay, so what you are looking at, this would be a change of character. Let me just mark out those areas. It's a change of character. It's a change of character. All right, that would be a change of character here, because new price has been formed, which is lower than this one. It's lower than this low. All right, so it has formed a new low, and now what we are anticipating, okay, here at resistance, we have our order block forming. It would be the last bullish candle. Looks like that. It would be the last bullish candle. Okay, I'll change that to blue. It would be our last bullish candle. Okay, it would be our last bullish candle before we see an impulsive drop, aggressive drop, which forms red candles dropping to the downside. Okay, it would be such an aggressive move that causes a change of character. Okay, this would be aggressive. Okay, so we will see such a kind of move to the downside, all right, which forms also fair value gaps. There's a gap in between here. There's this gap in between there. Okay, there's a gap in between there. So there will be a gap formed in between there. This is a fair value gap. There is an imbalance here, okay, where sellers were aggressively in control, that there is little or no buying pressure at all. So it forms an imbalance here, okay, that forms that fair value gap. There is an imbalance in the market. So when that happens, usually what happens is that when there's this change of character and there's a break below, price returns to close off the fair value gaps, okay, to mitigate the fair value gaps which are created here, and go to the order block. This would be our order block, and sweep liquidity below here. So our order block, we will also mark out the low and high. This blue candle here is our order block. We'll mark out the high, okay, that will be the high of the order block, and then the low of the order block here, okay. So that area would be our order block zone. This one, this would be our order block. This would be our order block here. So that would be our order block, this one here, okay. So we are waiting for price to get to this order block, sweep liquidity above it. So usually sometimes there is a fake out and a sweep of liquidity, either with a long wick or just some candles going up here like a fake out, before that price drops back down here. And we are targeting this new low right here, okay. We would be targeting that new low. All right, so that would be our liquidity sweep right there. Our liquidity sweep would be here, okay. Our liquidity sweep would be right there, okay. That would be a liquidity sweep here with a long wick candle, taking out stop losses, because previously some people had pressed their sell orders here. So if you have sell orders before here, let's say you had your sell order here, and you are taking your sell order here, and the price returned, this sweep would take you out, take your stop losses out before it heads all the way down, okay, all the way down. And there are some people who are buying in this area after this breakout. They think the price will, they think this is going to break and return and go higher. So when they place their buy positions, they are also taken out, because this price will drop again here and take out stop losses here. So it takes out stop losses above resistance, and also takes out stop losses of those who are buying below resistance. So that's what happens. So this strategy is very effective, because usually when that liquidity is grabbed above and below here, there is great momentum that pushes the price even lower here, okay. So it would be great, it would be a good thing to buy, a good opportunity to sell after the order block, at the order block, after the sweep, the liquidity sweep above resistance. You place your sell after you have seen a bearish engulfing candle, something like this. You'd see a bearish engulfing candle around there, okay, or 3 black crows if you like. You like 3 black crows formation around there, and then you can place your sell position just there, okay, and target the new low. You target the new low. After the liquidity sweep, place your stop loss above the liquidity sweep, or the wick that swept liquidity, and target the new low price here, where it returned over here. So you target your new low price here. Okay, and then after you've hit the new low, you are out of that market, you are out of that trade. It means you have made some money, you're out of it. Okay, it's usually 1 to 2 or even 1 to 3. If you have done your analysis on a higher time frame, this is more pips. You can even make a 1 to 4, 1 to 5 risk to reward ratio. Okay, so this is how you would trade this reversal strategy. On an uptrend, this would be in a bullish market. This would be in a bullish market. At resistance, you have to have the order block, you have to have the fair value gaps and imbalance. There's a change of character, which is this one here. That means a new low has been formed, all right? And there's a liquidity sweep up here, okay? And then you enter the market and target the new low as your take profit down here. This would be your take profit at the new low right there, all right? Okay, and your stop loss would be just above the liquidity sweep, all right? Just above the liquidity sweep, or the candle that swept liquidity up here. You would win that trade. So to show you this in the real chart, okay, this is our support, okay? This is our support area. This was previously a downtrend. This is a downtrend. The market is market structure is bearish. Okay, it's a downtrend. It's bearish. All right. So it's bearish. Then we go to this support area. Previously, this is support. All right. So we are waiting for price at support here. We saw, you see this last candle here. There is this small red candle here before the bullish candle. That would be our order block. So we draw our rectangle. You can draw a rectangle or draw lines. The upper and lower part of that candle would be our order block. Okay, in between that, the wick of that candle and the upper wick would be our order block. So in between here we have the order block. I'll just use initials. Okay, this would be our order block. Okay, at support, it is at support, because if you go back, this is a support area. Okay, so this would be a support. So this is our order block here. Okay, before this impulsive move, it's a last red candle before you see this impulsive move here. It's an impulsive move to the upside. All right, this is an impulsive move that causes a change of character. Why do I say it's a change of character? This is the previous price here. It has broken above these previous highs. This price here, it has broken above that. All right, it has created a new high price. It has broken above this old price. This is the old price here. Okay, and this is the new price here. Okay, it has formed a new price. So we are waiting for this. After the impulsive move, we can even see fair value gaps here. So I'll indicate here, this is a fair value gap. You can see a fair value gap here. This is a fair value gap. Okay, so I'll just indicate that there. This is our fair value gap. Okay, that's a fair value gap. This is our order block, and this is our support. Okay, and we have this impulsive move to the upside. Okay, this impulsive move to the upside that creates a new high. Okay, this is a new high. I'll just new high price here, new high price. Okay, that's a new high price, and it will be also our target for take profit. Okay, it will be our target for take profit. All right, up here is a new price at this circle up here. That would be our new price. All right, up there. So after forming that new price, okay, it has formed a new price. So we are waiting for it to return to the order block before we can buy. So this price, as you can see, the price action return to this here, because we wouldn't have traded here, it wouldn't work, because really this order block has not been closed out or mitigated. So would wait for the close of this fair value gap and the price heads lower, would be very patient, okay, until there's this close off of this order block. The order block has really been mitigated down here. So when the order block has been closed off, okay, the price even goes lower, a little lower than the order block, goes a little lower, showing some kind of liquidity sweep down here before this continuation to the upside, as you can see. So what would we do in this case? Okay, we can see this move down, all right, to the order block, and then now when it gets to the order block and the order block has been closed off, we are waiting for a confirmation to buy. So at this point, when we saw this bullish, you see this bullish engulfing candle here, okay, this bullish engulfing candle would be our confirmation for a buy, okay. After this liquidity sweep, you can see a little manipulation here, like a liquidity sweep down here, okay. That would be our liquidity sweep, okay. Sometimes there is a liquidity sweep, sometimes there is not liquidity sweep, but make sure you make your confirmations to buy in this area. If there's a bullish engulfing like this after the order block has been closed off, after it has been mitigated, okay, especially if there's a liquidity sweep, you place your buy order here, okay, you place your buy order here and place your stop loss just below the last that bullish candle, okay, and target these highs. Target this new highs up here, okay. That would be your target. You can see you take a 1-to-2 risk to reward ratio and you would win this trade. If you are patient to hold it, you would win this trade, as you can see. All right, so that is how you would trade this strategy, reversal strategy. In a bearish market, remember, you are looking to buy at the reversal, at the order block. After the fair value gap has been mitigated and at support, you have confirmed it's a support zone and you are waiting for your confirmations after the order block has been mitigated. Then you look for areas where you can enter after your candlestick patterns in the lower time frame have been confirmed. All right, so this is how you trade it in the bearish structure or in the bearish trend market. Previously, we can see this was very much bullish previously, okay. So we can see this was bullish, okay. This was a bullish structure, and here we can see the order block formed, that last blue candle, bullish candle, before this aggressive this bearish move that formed a break of structure to the downside, okay. You see this break of structure right there. I'll show you. There was a change of character here, change of character here. This is our change of character. This is our change of character to the downside here, okay. A new low has been formed. This is our new low here. All right, this is our new low. This is a new low here. Just want to mark that out to be clear. This is a new low. So after the order block has been formed, our order block here, we're going to mark it out. This candle here, I'll just form this, okay. I'll extend it all the way. Okay, so this area here is our order block. This would be our order block. Our order block would be that area, okay. Stretch it all the way. So we would consider that price, after breaking below, forming a new low, it would return to the order block and mitigate it. But in this first case, this order block really, not really, it wasn't closed off. Now, so I would wait, okay, I would wait until this move here, this is the one I would consider, this one here, Okay, I would consider this one because this order block was at least mitigated. It was mitigated here. So I would look for my sells after this bearish engulfing candle here. You see this bearish engulfing candle here, this one. I would consider that bearish engulfing candle and place my sell position there and target all the way. I would place my stop loss just above and place and target this new low here, this previous new low, or even target this one here. Okay, I'll place my trades just like that easily. You make a 1 to 2 risk to reward ratio and you are out. But as you can see, this even continued to a 1 to 5 risk to reward ratio. But our initial target would be our new low, which is this one here, and you make a clean 1 to 2 risk to reward ratio in this case. So that's how you would trade this strategy. It's a very effective strategy. I believe that you have got value from this content, and consider liking this video and also subscribing to this channel if you haven't already. Until next time, peace.